Okay, here we are. Welcome to this week's Wealth Creation Show, and not the typical usual destination, is it?
Here we are.
This is Necker Island,
Yep.
and somewhere there is Larry Page from Google's Island, just over the water,
Yep.
and then somewhere over there as well is Punch and Gorda, Pickle Pear, whatever it is. But yeah, beautiful destination today. I think we need to do the podcast over here a bit more.
That would be, that would be good. I think on a weekly basis we need to be here a lot more.
Yeah, so what we're going to talk about?
So we're talking about understanding the true investment return.
Okay.
And I think which is quite appropriate, because understanding that true investment return takes you somewhere like this, because your business will exponentially grow
Yeah,
with that
potentially, yeah.
better understanding.
And this is where, when it comes to investing, most investors, well, many investors focus on headline figures.
Yeah.
Annual percentages, gains, dividend yields, gross dividend yields. For example, if you're using a mortgage, gross dividend yield means nothing to you. You should not be using that at all. You should be using net dividend yield, which is after the mortgage is paid and what you get out of it after that, versus what you've actually put in. Now, I'll give you an example of that. I'll buy a property for 100,000, and it's £6,000 a year rent. Okay, you probably get better rent nowadays for that, but let's say 6 for the simplistic effect. So £6,000, 100,000, 6% gross yield. Now that's if you buy it cash. But if you leverage that and you're only putting, say for example, I don't know, say you put 10,000 in to make it easy. I know you can't get 9% loan to values, but if you put 10 grand in and that's all you had in, and you maybe got £3,000 interest against £6,000 rent, then effectively you'd have £3,000 for £10,000. So your net yield with after the financing costs would be 30%.
Yeah.
So you've gone from 6% gross to a net return of 30%. Now that's before you take off things like insurance.
Yeah, your property insurance, stamp duty and things as well.
Yep. So property insurance, stamp duty, everything else as well. And that's the sort of thing, that's how you have to look at it. Now we've got previous episodes on here anyway, in this playlist that we've got for the Wealth Creation Show. It will actually explain to you how that's all done in major detail. If you want to know how on a one-to-one basis, then reach out to Richard.
Yeah.
More than happy to go over these numbers with you. So that's the sort of things they go.
Yeah, I was just going to say that, like you're saying there about these headline figures, and they are important, like the growth and things, but when you come below the surface there and really look at it, that's when you then calculate the true investment return that you're going to get from an investment, rather than just concentrating on these headline figures.
Yeah, so true investment return is what I would say. So is that nominal versus real return?
Yeah, nominal versus real returns, and that's the most basic measure of investment and performance. It's the nominal return, you should say, so, which simply reflects the percentage increase in an asset's value over a period of time.
Yeah, so I talked about 30%, that was quite interesting. Yeah. But also you've got the appreciation of the property.
Mm-hmm. Yep, capital appreciation.
A capital appreciation every year, so you're getting a 30% net return after the interest is. Hello, McFly, this is the perfect way to do it. Leverage is a great position to be in.
Yeah.
Now, I explained to you about 90% loan to value. You would never do that more than likely because you're over-gearing yourself. Over-gearing means you've got too much borrowing against the actual nominal amount you put in. Generally, most buy-to-let only go up to 75% loan to value, which is, if you've got £100,000 property, you put 25,000 in, they'll give you 75,000, and then you work from there. It's the same calculation, the way you do it. Whatever you get after the mortgage is paid, the interest part, not the interest on the capital, because there's two elements. And personally for me, this is just my own personal choice. I do interest-only mortgages, because it makes it nice and clean for cash flow. Because if you do capital repayment, you're having to pay cash down every year. It might be a good thing for retirement, but you're then eating away into your cash flow, which could otherwise be used for your repairs and improvements over time.
Or reinvestment, yeah.
And then the argument of that as well is you do interest only, it's deductible immediately, and then it's easy to calculate all your returns from there. And then also out of that as well is you've got the cash to do the repairs and improvements.
Yeah.
But then if you do want to and you don't need to do the repairs and improvements because the property is quite good, you can maybe get to the end of the year, the other year, and decide to pay off maybe up to 10% of the actual mortgage payment itself. Because you can do that.
Yeah.
Most mortgage providers in the numbers, sun's coming.
Yeah, she's got it fixed.
Most mortgage providers in the numbers is like, this one half will be tanned and this one half won't be. I'll be going back with a brown bit and a white bit on this side.
Just about like the nominal returns you were saying, and then what about like inflation? Because then inflation obviously has an effect on that, and a lot of people don't take it into account how that could potentially erode these nominal returns and erode the purchasing power.
Yeah, I mean, inflation is a big hit on that. To be honest, I'm never really focused on inflation, because if you look over the last 50 years, the last 20 years, the last 10 years, the last 40 years, property's always outstripped inflation in terms of the appreciation. So I've never really focused on inflation as such, but I know it's been a good hedge against inflationary pressure for your investments. But the key thing about inflation is, what we don't understand is what you're doing is you're investing your money, but you're beating inflation. You're also beating probably the market as well. I mean, you could probably be beating the stock market as well itself if you get the numbers right. Now, that's so important.
Yeah.
Numbers are key here, every single time. This is just a numbers game. I know we deal with people, and that's fine, and it's all about customer service, it's all about giving them what they want, but getting the adequate return at the same time. And if you do that right, you will get the right return. You'll get high occupancy rates. We'll be talking about that later on as well, what that means for people that don't understand what an occupancy rate is, how important that is in terms of rent. Or should we cover it now? Occupancy rate?
Yeah, just we'll go for it. Because I'm going to talk about costs and charges and management and things to take into consideration.
So occupancy rate is how much your property is occupied within the yearly period. Usually it's year to year. It could be April to March. It could be January to December. But it's a 12-month period. So occupancy rate is how much it was occupied. Now, that's the occupancy rate, which is important. So that's occupied 100%. But the other one to keep an eye on is the rent efficiency.
Yeah.
And what do we mean by the rent efficiency?
Yeah, so like the rental amount, how frequently you're getting that, and how much how often that's coming out.
Yeah. So if you're getting £6,000 rent a year, you want to make sure you collect £6,000, and that means it's 100% rental efficiency. But you could have an occupancy rate 100% and go, yee, my occupancy rate's up.
Yep.
But you could end up collecting only 80% of the rent because maybe the tenant can't afford it that 1 month or a previous month, or they maybe just stop paying because they've lost their job, or they're in a difficult situation. Maybe a partner leaves. So then that's another efficiency measure you've got to record. So your occupancy rate could be high, your rent return could be high, and these are the things you have to take into account when you're actually looking at all the genuine returns on investment. But again, inflation will come back to saying, long term, medium to long term, property generally always outstrips inflation. And it has been for the last 50 years. It doesn't mean to say that it could be for the next 50 years, but I kind of think when you think about property prices going up, but also salaries are going up, affordability is easier. I mean, apparently, today, first-time buyers are better off by 26% in buying a property than it was, I think it was 10 years ago, maybe 15 years ago, 10 years ago, So that just shows you, and everybody goes, wait a minute, how is that possible? Property prices have gone up far so much since then. But you don't understand, their income's going up at the same time. So therefore, in the proportion of their income, if it goes up, is a better proportion that could go to funding, because interest rates as populace come down, and mortgages are easier to get and cheaper to get as well, as opposed to what it was 10 years ago, maybe 20 years ago, maybe 30 years ago, and especially in the 80s. God, it's almost 40 years ago. How old am I? That's my generation. The 80s. You were just born in the 80s.
That was 86.
Wasn't it? It's like, so 80s. I was 20 when you were born. So the 80s, when I had my first time house, my first time buyer, 20 grand it was, for a 2-bedroom flat. Our mortgage was represented was about 53% of the actual money we brought in, because interest rates were up at 15% at one point. Yeah, Mortgage
Yeah.
rates were up at 15% at one point. So it's become a lot more affordable now to buy. Banks are making it easier.
Yep. I think you're talking about these key indicators, things like the occupancy rate and the rent and things as well. Mortgages, they are quite readily available. They do come with a cost. And this is the thing where you're doing this initial analysis of an investment. You
Yeah.
have to think about, is it going to let? Is it going to be filled for 100% of the time or 90% of the time? Am I going to have a good rent return? But also, you've got a mortgage product, you're going to have a cost involved with that. Am I going to have an agency manage it? I'm going to have a cost involved in that. This is all going to come off the bottom line of your investment, so you need to take all that into consideration, like costs and charges. A lot of people don't think about that further down the line, and all these costs they've bought an investment that then doesn't end up actually making them any money because
Yeah.
they've not worked it out right at the beginning.
That's actually quite true. I mean, personally for me, things like brokerage fees, arrangement fees for mortgages,
Yep.
you typically get a reduced rate if it's a fixed or if it's a tracker.
Yep.
If you're prepared to take a higher arrangement fee. And but the good thing is the higher arrangement fee could be added on the price of the mortgage. And everybody goes, oh my God, it's like, why would that? That's just getting you more debt. But the thing is, the arrangement fee is a proportion of the total funding. It's probably less in terms of that. And if you break it up, you can work it out. Basically, if you've got no arrangement fee for your interest rates versus a fixed fee for your arrangement fee, you'll probably get just so no is higher rate. Fixed fee is usually typically the middle band rate, and if you're prepared to take the full whack for the arrangement fees and add it on, then you usually get a lower rate in the beginning to the other two as well. So there's 3 different tiers based on what rate you want. Now you can easily work that out by working out, if it's over a 5-year period, what is the total cost of each one in terms of interest, and then working out the differential between each one, and then working out how much the arrangement fee is in each one, and then you'll be able to work out roughly which one's more attractive.
So then that means it's not always the one with the lowest percentage, which is the most cost effective.
No, it's not.
Yeah.
It's not always the one with the lowest percentage. Plus the fact is, it's not always the one with the lowest percentage. And that's probably, it just depends. And again, reach out to us and we could have a chat with you about that if you're looking to invest in property, or if you're looking for advice and support on that. We'll be able to go through these numbers for you and actually show you how that's done.
Taxation things as well, and obviously there's been a lot of change in taxes since the budget yesterday, but stamp duty, it still remains at 8%. You need to think about that when you're doing a purchase.
ADS.
Yep.
Yeah, ADS is quite important, I would say, definitely. So ADS, which it's currently running at 8% in Scotland, it's 6% in England still, I think.
Yeah, it's still
And it's additional dwelling supplement. So if you buy a second home, which is a buy-to-let property,
additional to your primary residence.
additional to your primary residence, then and you're going to rent it, you're going to have to pay either 6% or 8% depending if you're England or Scotland or Wales or across the British Isles. You're going to have to pay that whether you like it or not, additionally as a tax over. Now, for me, it's just money in the fire. But when you think about the logic of it, if you're making a 30% return on your income and you have to pay 8% in the beginning, it's kind of a no-brainer for me. When you work all that out, it absorbs it over a period of time, and it's certainly more attractive. Plus the fact that you're using the bank's money all the time, so you've, for example, you've got a £75,000 loan, and you've only got 25,000 in. Remember, you're appreciating on a £100,000 property value. So if you're making 5% appreciation a year on property value, you're making £5,000. If your arrangement fee is 3% of 75 grand, hello, McFly, that's a no-brainer. First year, or less than the first year, that money's just got back straight away.
And see, when you think about all these costs as well, and it brings us back to the nominal versus like the real return. And I see this quite a lot, and you'll have agents and things advising people on the gross return on a potential property investment, and they base that on the purchase price.
I do that every time. You've got to watch out for that.
And the rental price, and that could come through say 8%. But really, once you factor in all these costs, it could be as low as 5%. And really, you don't want anything less than 6 at the most.
So net return for me is as I talked about, the key is especially, well, net return in anything. It's not about the gross rent yield because it looks attractive, but it's no when you're crunching all these numbers, as you said, Richard. When you talked about things in costs and charges, when you take insurance in account, you take in repairs and improvements, and you maybe come up with for insurance repairs and improvements and incidentals for the property, and property management as well, you maybe come up 30% of the top line rent. Is probably a good indicator to do. So you've got your top line rent, you've got your mortgage interest to come off, then you've got 30% of the top line rent to come off, then you get your net return at the bottom, and the net return is measured against the money you've got in. The money you've got in is the ADS you have to pay, the legal fees you've got to pay, the down payment, the deposit you have to pay to get that property, and possibly if you're not going to remortgage, the repairs and improvements you have to do as well. So that's the money, that's the benchmark, the net return you've got to compare against. I mean, the first one was about leverage that we talked about in the beginning, but this one is about bottom line comparison against everything that's gone in. So for me, that is probably a key indicator as well, to assess and measure.
So then that brings me to, you know, you do this and you do all your numbers and you get your numbers right and you've got your investment property and you've got it set up. Then I wanted us to talk about compounding, which is your favourite thing. You know, the actual value of the time value of money and compounding. Once you've got an investment in place, it's so important to be patient, have that time and let the money compound up over time.
Remember that, 8th wonder of the world. Compounding. 8th wonder of the world. You cannot believe it. For anybody that doesn't understand compounding, put your teeth back in. It shows it's live.
I know.
With no editing things. Raw, live, here we are now. So, compounding. Let me give you an example of that for people that don't understand this. What compounding really does for you. An investment strategy. I can give you 1 pence doubled up for the next 31 days and give you the end result. Or I can give you £5 million in your hand right now. Now, on the face of it, and I answered this question like this as well when somebody proposed that to me, I went, give me the 5 million. Because if I get the 5 million now,
that's what you would think straight away.
Well, if I get the 5 million now, it's in my hand, it's like deal or no deal. 5 million, and the rest is 31 days to take a chance on anything else happening. So there's pros and cons to that. You've got 5 million in your hand right now, you can do something with that right now. You could probably get ahead of the game right now in the 31 days that you would double up everything else to get whatever it is at the end. But the 5 million that you get is compared to 1 pence doubled up for 31 days is 11 million. 1 pence doubled up for 31 days is 11 million.
You work that out. I had to do that.
That is absolutely, yeah, I've got a calculator as well. I went 1 times 2 times 2 times 2, 2 times 4 times, 2, 8 times 2, 16 times 2, 32 times 2, and just keep doing that.
Not a good example of compounding there, and if you stop short of the 30 days, the difference in what your end total would be.
Well, here's the key with all investment strategies and compounding. It's not just for property as well, it's about doing it earlier, especially with pensions as well. You know, I'm not a pension expert, but I do know a bit about pensions because I've invested in my pension myself. So this is what I did personally, and this is what I did for my children as well. I started early for them because I realised the end result of the 31 days. Because if you didn't do the 31 days and you did 30 days instead, the end result would be 5.5 million rather than 11 million because you're another 1 day. But what you have to understand there is, if you can't wait another day at the end of the 30 and wait for the 31 to happen, maybe because there's a timeline on it, then were you not starting now, earlier, 1 day earlier, that 1 day earlier that you thought in the beginning was only 1 pence, was actually costing you 5.5 million. And that's the thing about compounding. It is astronomical where you could be. It's astronomical where your children could be, where your grandchildren could be, where your great-grandchildren could be, and it should be taught in every single school what compounding means and what it means for other people. I think that's the most important point. So compounding is so important, plus the fact it protects your investments as well. It's a great hedge because you're doubling up, or you're whatever it is, if you're making 5% a year, 2% a year. I mean, look at your interest in your bank. What, 1.5%? Oh, but I get my son, I get 3%. Well, not for long. The way the government's going, the way this government's going, or any government to be honest, I think they'll just look at it as an opportunity to get more money. in all honesty.
Yeah.
So you've got to think about where you're going to put it in order for it to maximise its returns and get the full benefit out of it as well.
And the compounding as well, it's having the patience to let it compound and give it that time, rather than looking for quick returns. So you're not talking 5 years, you're talking 10, 20 years.
Absolutely. So this is the phrase it pays. Boring pays well.
Yeah.
Boring pays well. Why does boring pay well? Because if you don't touch your investments and you just keep putting that money away every single month, at one point in time in the next 20 or 30 years, you'll open your bank account or your pension fund or anything like that and you go, oh my God, that has compounded in an astronomical amount. It does take into the account of also charges on a pension. Make sure the charges are as minimal as possible. Go for lowest cost charges, because charges, an extra 1% on a pension, it could cost you, it doesn't just cost you the 1% every year that you're losing on your pension, but it compounds as well. So that 1% ends up compounding, and some people's pensions could be anything from losing from 50 to 300,000 at the end, just because they didn't realise that it's the same principle as compounding is for the fees as well.
Yeah.
So that's another thing to remember. So this is about understanding the true investment return. It's not just thinking it's only 1% of the payment. No, it's 1% of the fund.
Yeah.
So if you've got a £100,000 fund, it's £1,000. Yeah. You've got a £1 million fund, 10,000? Ah, it's 10 grand. Just like that. How do you want to lose 10 grand? Get a fund that actually charges another 1% than everybody else is charging it, and you lose 10 grand every year. But you don't lose 10 grand every year, because you lose a return on the 10 grand every year after that as well, and the return on every 10 grand that you lose every year with that 10, and even more because they take 1% of the fund as it grows, bigger and bigger and bigger. So that's why it's important to watch out for your pension fund charges.
We've done the interactive calculation with that on. It was a few weeks back from the shows. So if you go back and look on that, I can't remember what show it was on, but you've done it on the...
So annualised returns, rather than simple cumulative gains,
Yep.
offer a more attractive or accurate measure of performance over time.
Yes.
And that really allows investors to compare investments with different timelines effectively. Now, past performance isn't a measure of future performance, remember. That is key.
Yeah.
And I've seen that. I mean, this is before you were born, probably. This was a huge mis-selling scandal, I suppose,
Yeah.
where everybody was using the past performance as an example about where the fund could be in the future for endowments, for example.
Yeah.
And the endowments were basically mis-sold at that time, and that's why all that came up with the mis-sold endowment scandal. Because they were saying, oh, well, we've got 50% in the last 20 years. But what they didn't fail to say was inflation at that time was 25%. So they were getting 50%, but they were actually losing because the inflation was 25%, and it was that every year, and they got 50% over a 20-year period, but inflation, that's only 1 year. So that ate right into it and eroded everybody's savings. So I think that's what a lot of people have to remember. You want to talk about risk-adjusted returns?
Yeah, risk-adjusted returns. And it's really just not all returns are created equal. You know,
Yeah.
There's two investments and they may generate similar nominal returns, yet carry really vastly different risk levels with these two different investments. And there's metric things in that you use, such as the Sharpe ratio and the Sortino ratio, and they're usually quite useful for understanding.
You remember that, because I've done it.
Yes, but they're usually good for using that. They're useful for understanding that return and how it relates to the volatility and the downside risk.
That's right. So I'll give you an example of that, for example, with your funds, or your pension funds and that. I'm with Standard Life. There's other pension fund providers, to be honest. I'm in UK equities, and that's what I'm in. And that's categorised as a risk category of 6.
Yep.
Now the highest is 7, and that's international equities. And things like bonds and savings funds for your pension and putting it there, and gilts, stuff like that.
Yep.
That's a lower risk, so that's like a 1, 2, 3 and 4 category, whereas now to me, UK equities always go up over time. So personally for me, I don't see that as a 6 category, but they have to do that. They have to give it some sort of risk, and that's what I mean. That's why it's so important. So I think when you're looking at your risk-adjusted returns
Yep.
and how that works out, in layman's terms, it's more what sort of risk do you put on it for you? In other words, if anything happens, can you get this money back out?
Yeah.
Would you need it?
Would you be able to get access to it? Yeah.
Can you afford to lose it? You know, that's another risk you've got to think about. Because then that's effectively saying, okay, if you can afford to lose it and you really want to take that high risk gamble,
Then that's short.
it's kind of not a gamble, but maybe we're talking about crypto here.
Yeah.
Gamble. So if you want to take that high risk, then you've got to take the opportunity you actually could lose it.
There's always that risk involved there. Could do it.
So that's the sort of things for the true investment return
Yep.
and what you earn for the risk undertaken.
Okay.
Opportunity cost for me.
Opportunity cost. Well, I was going to let you cover opportunity cost.
See that big grin? Opportunity cost. What is the opportunity cost? I'll give you an example on opportunity cost here. I'm going to buy a Lamborghini Huracan. I am not, by the way. But I did consider it. So a Lamborghini Huracan to me was £178,000 cash.
Yep.
And then I thought to myself, wait a minute, what can I do with that cash if I don't buy it? Because remember that Lamborghini Huracan is not just £175, 170,000. It's the cost every year of running it. It's the petrol. It's because it's a lot more petrol consumption than your wee smart car or something like that, or even a hybrid. Then you've got to think about the tyres, because you might have to replace tyres. You might have to get it serviced every year to keep the warranty in place. You would have to do that.
Yeah,
So
for sure.
service will be about £3,000 or something. So when you add all that on every year, and all that time you're owning this car, then that's eating into what total cost as well.
Yeah.
So you could be the best part of 200 grand. Now then, when you think about what you can do with 200,000, invest in property, for example, you could take 200,000. You could divide that by 25%. It's 25% loan to value.
Yep.
75% loan to value. So 25% division, that 200,000 could probably buy I don't know, what, £800,000 worth of property or thereabouts?
Yeah, probably,
Or 600,000 something, I don't know. I think it's 800,000. So that could buy you £800,000 of property. But that could buy you 8 properties if we made it simplistic here. Remember, these are just numbers. You have to work out individual things. And it will be more complicated than that. It will be more costly than that. So let's not get delusional about this, but for the exercise of simplicity, I say you could buy 8 properties. And if we can get a return off of these 8 properties at 800,000 and appreciate every year at 5%, you're effectively making 800,000, 40 grand a year. So you're making 40 grand a year. So that is the opportunity. So you go and buy the Ferrari, it's costing you 40 grand a year in opportunity cost. Because immediately you've demonstrated you can make 40 grand a year just in appreciation. And then you've got the rent to take into account that you would get. Maybe the net rent, because you do loan to value. So we work that out and we said to ourselves maybe 30% of top line rent, which is about, about 2 grand. So 3 grand, 2 grand, so you're £1,000.
Yep.
So £1,000 every year out of that at the end, plus the appreciation. After all, I mean, the fees might be less, your repairs and improvements might be less. So that £1,000 might be a bit more, but for simplistic and make it really prudent,
Simple,
conservative with a small c. I'm an accountant by trade, so that's how I look at it.
Yeah.
So in the worst case scenario, you're left at £1,000 a year net return. So £1,000 a year for 20 years is
the compounding
20
effect,
grand.
yeah.
So £1,000 a year, 20 years, 20 grand. Now, rent will go up, but we'll assume that inflation will take into account the rent as well. So another cost as well will be equal. So everything's equal, 20 grand over that year. But then you've got the 5%, you've got 40 grand every year. So 40 grand times 20, 800,000.
Yeah.
What? You just doubled your money over 20 years.
But that demonstrates as well the patience of letting it compound.
You've not just doubled your money though.
Because
actually
the capital appreciation.
Quadrupled your money.
Yeah.
Because you've only put 200 grand in.
Yeah.
And everything else has been serviced. The debt has been serviced and everything else, and the costs and everything it runs. So you've only put 200 grand in, so you've got a 400% return over 20 years.
Plus the portfolio will be worth a lot more in terms of.
So the 800,000 you've appreciated in value, the 20 grand you've made as well, 820,000, and that's the return that you would lose over 20 years if you bought a Huracan. Plus, you would also have, and we'd assume for simplistic, the running cost would be like, I don't know, the 22,000 over these years, assuming nothing seriously goes wrong. But if something seriously goes wrong, then you're going to have to replace an engine, you're going to have to replace a panel, you're going to have to replace something else, you're going to have to replace an exhaust. That could be a hell of a lot. So when you think about it, 400% return. So the opportunity cost to that is, by buying a Lamborghini Huracan in that instance, is that Lamborghini Huracan isn't going to cost me 200,000. It's really going to cost me 820,000 to buy that over the 20-year period. That's the return you're losing.
We did do a show on this.
Absolutely.
That's way back at the start of the series.
We've got to show opportunity cost.
Opportunity cost. You'll find
It's
it
on
in
the
the,
actual,
in the
on the
playlist.
presentation
Yeah.
show on the playlist.
Yeah.
So that's another one as well, the opportunity cost.
Yes.
But even profitable investments can be suboptimal.
Yeah.
For example, UK pensions invested in corporate bonds, yield 3%.
Yep.
It may seem safe, but during a decade, when equities is 7% annually, the opportunity cost is actually significant. So this is the risk.
Yeah.
So you take the wee bit of higher risk.
Wee bit of risk, yeah.
I can't see a risk. It's like UK equities, Standard Life, for example. Again, other funds are available. I mean, you're investing in Diageo, you're investing in Glencore, you're investing in a few high blue chip, high pharmaceuticals. You're investing in bar industries,
Do you
which
know what
is
name
vape and all the rest of
it?
it. Yeah, I'm naming them because it's like these are blue chip stocks, and blue chip stocks are generally quite safe because they are designed and they're more or less engineered by the companies that run them for pension funds to buy them and actually buy into their stock. And they generally have a return every year in dividends for that reason. So I think blue chip stocks are good, but that difference between 3% and 7% compound over a 20-year period, and you could lose a lot of money. Plus the fact, when you look at pensions as well, I mean pensions just now, but that's going to be different in the future, is going to also give you the tax back. So you've maybe taken the money out as a pay, you've had to pay tax on it. You put it in your pension, you get that tax back on it. If you're a higher rate payer, you get in your better pension, you get a better return because you're actually getting the higher rate back on your income tax return as well, which is actually quite important. Low interest savings account.
Yeah, savings account for low interest, yeah. And that versus the interesting about like diversifying, you know, that like your ISA portfolio, that can lead to substantially missed gains over a long period of time.
Over long terms. So what examples have you got?
Yeah, so
what could you
a
think?
couple examples for UK specific examples for true investment return, and then stocks and shares ISA, as we were just saying there, but a long term investment in a diversified FTSE 100 tracker fund might show maybe 7% nominal growth.
Yeah.
But then after inflation, when you've got platform fees and occasional
3%,
0.5%,
0.5%.
for your platform fees, and then you've got occasional capital growth tax outside ISA limits and things as well.
Yep.
That brings in your true return back to something that's closer to about 3 or 4%.
In real
terms, yeah.
Yeah. In real terms, what we mean by inflation, let's say for example, Mars bars a pound.
Yep.
They're not dealing nowadays, to be honest.
They're a bit 150, I think.
Right, okay. I remember when they were like 5 pence or 10 pence to buy. A car on my back. I've got 5 pence. What can I buy with 5 pence? I can't buy a car on my bar anymore because they're £5. But that's inflation that erodes that. So what you bought for a pound this year, if it's a 5% inflation, then you're probably only going to get 95 pence worth at the end of the year, because inflation's eroded that value of money. You can only buy 0.95% worth of that what you bought at the beginning of the year. That's how inflation erodes it. But the great thing about inflation, it also erodes your mortgage.
Yeah.
Because your mortgage is sitting at 70 grand, and the money that you're actually borrowing, if you're borrowing 70 grand all the time,
Is that different?
yeah, that 70 grand's going down in value every single year, while your property's appreciating every single year, in terms of what the purchasing power is for that. So you've actually got a real gain happening in between. Buy-to-let property, London, regional.
Yeah, buy-to-let property, obviously we've covered that a bit, but the buy-to-let properties in London versus the regional area of the UK. So in London, properties may see maybe a 6% rental yield.
Yep.
But when you think about the mortgage interest, your agency fees, the maintenance, the net yield then drops to 3-4%.
If you're lucky.
Yeah. And then if you, in contrast, if you think about the regional areas,
Scotland,
and obviously the north England and things as well, they may offer somewhere 5-6% yield with lower costs given
I wouldn't get out of bed for that.
Yeah, I know.
25%, here we come.
Yeah, but but then,
People won't believe me with that. Believe me, you will not believe me with that, but I could show you these numbers how that works.
yeah, but then at that level, when you've got lower costs and things involved, it gives you that higher risk adjusted return, basically.
Yeah. I remember I said that a government sort of thing, and Patrick Harvey was there from the Greens, who was the Minister for Tenants at the time.
Oh, I think I was that way.
Yeah, you remember that? And the boy shouted to the audience, "Have you told Patrick Harvey you're making 25% of your money?"
Yeah, I remember
And I went, "What's it got to do with him, like?" and everybody just went quiet, and then we moved on to the next subject.
Yeah, that was over in Glasgow. Okay. Yeah.
Thank you, Patrick, for putting the rates up. the Rent Controls Act has actually allowed us to put all the rates up by return. So the Greens have actually done us a favour and actually put a tenant tax in place. Well, that's another story.
Yeah. What about workplace pensions? Just quickly, we spoke about private pensions and things, but the workplace pensions.
Defined benefit contributions. So defined versus defined. It's usually and typically with a 5% annual growth.
Yeah.
It may seem attractive, however, after management charges, we briefly spoke about that in the beginning. Inflation and early withdrawal penalties, the real compounded growth could be half the headline rate over 30 to 40 years. You wouldn't believe the amount of money you're actually losing.
Yeah.
Your charges are high on your pension.
Yeah.
Me personally, I mean, I now have a pension which is charges of like 0.6% every year, because I'm in drawdown mode. But I'm not taking out. I've only taken out my tax-free element. I've left the full taxable element in, so I'm still allowed to put up the fuel contributions in up to £60,000 gross just now, and still get the attractive tax rebate on it, the tax added back.
Yeah.
Whereas if you draw down the drawdown amount, it's taxable, then that drops immediately to about, I think it's 10,000 just now. And look up there your own area, because this could be dated as far as we're concerned. So look up at that time, take financial advice from a pensions advisor, but that could drop as a result. So it's quite attractive to do that, because it gets that out and you still let it put the same amount back in. But also the fact that you could still continue to put the amount back in, and pensions are really, workplace pensions especially, could end up being like that. But that doesn't, because you've got a workplace pension, that doesn't mean to say you can't have a pension outside of that as well.
Yeah, I've got to, yeah.
Yeah, because personally for me, this is how I view workplace pensions. It's only a way to get the government to get responsibility off of them to do it. And that's why they're doing it. But what you don't understand is, you'll think because you're starting a pension, you're going to be minted by the time you retire. But the reality is, everybody else is doing the same thing. So they're all going to have the same purchasing power when they retire as well. And guess what happens when everybody's got the same purchasing power? Inflation goes up.
Yeah.
Yeah. Inflation starts to go up. Because all that money starts to come out of the system and starts to get spent because it's locked in there. And this is why the government's making kind of trying to get people, and they're taking pensions into inheritance tax. That's what they're doing.
Yeah.
They're deliberately doing that because they realise there's a huge amount of money in there, which is an opportunity for them to tax this as well. It's like, I'll be honest, you'll be taxed to your death. That's literally it. And personally for me as well, state pensions won't exist in the next 50 years.
That was the whole point of starting.
They'll be phased out.
The workplace
They'll be phased out. That's what they're doing. They're just trying to get rid of the responsibility. Like most private industries have got rid of their responsibility as well. If you were a public service, in other words, you're employed by the government or anything like that, it's a different situation for you. You're I can't remember what it's called now because it's been that long. You're guaranteed a pension, like 2/3 of your salary or something like
the
that.
public's
But for me personally, it's like, it's 2/3 of what you couldn't afford to live on in the first place. So you need to put some sort of provision in place to make sure you're doing something. You need to be doing something more than what everybody else is doing, because that's what will set you free, way beyond everybody else, when the time comes. Because you'll have more choices as a result, and that's what it's about. Now I hear you saying at this point in time, I've not got any money to put in, but you get a salary rise every year. You're maybe living in a bigger house. Sell that Porsche. Gordon Ramsay was told that by his father. But his father-in-law told him that. They wanted £20,000 to buy their first house, and he went to his father-in-law and said, I need £20,000 to buy my first house. I've got 20 grand already, I need 20,000. And his dad gave him the best advice possible. This is what he said, the best advice he ever got. His dad said, you need to sell your Porsche first.
Yeah.
And then come back to me. And Gordon Ramsay swears that was the best advice he got. sell your post first. Get rid of the stuff that's costing you money. Then we'll talk about doing that. Because then that's what happens. You live in a house. I did it when I was younger as well. I wanted to live in a house almost as big as my mum and dad have, and they were at it for 40 years, and I wanted to live it in 40 days.
You done it that way, and then you realised.
Yeah, I lived in a 3-bedroom semi-detached from a 2-bedroom flat. I moved from the 20 grand one I talked about.
Yep.
Well, we moved from that to a 3-bedroom semi-detached house, and I literally had a room that sat empty for years, and it just became a stock room, you know, for all the waits and say all the stuff that I didn't want.
Yeah.
And I'm paying to have this room and heat this room, and I'm paying council tax for this room for a room I never used, and I really resented that after a time.
Yeah.
And I thought to myself, this is crazy. I need to sell this house. So I sold that house, got a 2-bedroom flat for half the price, half the mortgage. My wife retired at that point. She took voluntary redundancy, got 3 times the amount of voluntary redundancy at that time. That's what was getting offered, and I invested in property.
See, this really falls nicely into what I wanted to kind of finish off talking about. It's the behavioural factors that influence your decision-making processes and how you actually invest. You know, the human psychology around it, and it profoundly affects how you realise investment return, and like make emotional decisions, or you know, having your mindset to the where it's like, let's take these expensive things and costly things out of the equation, so that I could use the money to
I've got my
invest.
stocks in the stock market. The stock market takes a tumble because maybe Trump decides he wants to put tariffs in place. Has that happened yet? Yeah, it has.
Yeah, I was just going to say, yeah, it has.
I'm dating this. When you think about it, it's like no. He's decided to put years ago. Decided to put tariffs in place.
Yep.
And all of a sudden the market took a dip by 20%. Now market takes a dip by 20% because everybody starts selling. They start selling off and
panic
trying
selling,
to take profits. That's the panic selling. But the key is to keep your head while everybody else is around you is panicking, is losing theirs. So keep your head while everybody around you is losing theirs. That is another key phrase to remember. Write it down, because I tell you, you read that every single day, you'll understand this.
Yeah.
So market dips 20%. What do? I run in and buy more stock for my pension.
Buy as opposed to
I
sell.
put more pension, more stock in my units. Less than 2 months later, market recovers. I made 20% on that money within 1.5 months. A 20% return in 1.5 months. Not a year, 1.5 months, 20% return.
Yeah, but a lot of people might think, but there was risk involved in that.
There was no risk.
It was always going to come back to where it was eventually. So if you didn't need that money and you could sit it in there until it recovers,
I'll be honest.
then
Yes, I look on the principle, the old risk thing about can you afford to lose it? I probably couldn't, but I wouldn't bother that much.
it wouldn't have been the end if you had. Yeah.
But I know with tracking the FTSE 100, I know with tracking the FTSE 100 over the years, when any events happened, I mean 9/11 happened and it dropped like a stone.
Yeah. There's a film about that. There's a film about that where they all jumped in at that point.
Yeah, I bought at that point as well. It's like the market dropped like a stone, and I went, "This is a buying opportunity." So while everybody else was losing their heads, I jumped in and bought.
Yeah.
It made absolute sense because the reality is, if it stays there, then we're all in the same position.
Yeah.
If it tanks and we lose everything, guess what? We've all lost everything.
We're all in the same boat.
Yeah, we're all in the same boat. If it increases, I'm no longer in the same boat. I'm way ahead of everybody else.
You think you're in the yacht?
Yeah, I'm in a yacht. I'm in a cruise liner, on my own cruise liner. It's like I'm in one of these. I'm in the Tatiana. This is John Caldwell's super yacht. Not that I'm promoting it, but that's a wee shout out to John Caldwell. Pods for you. So, to me, that's what makes absolute sense. So I've actually looked at the market all these times when events like that. I mean, when the credit crunch happened as well, the market tanked as well, and I looked at it again as another buying opportunity. And these are the things that you've got to watch out for. So watch when people start panic selling,
And think, should I be doing?
and
Should
look
I
at the
be doing
trends.
something different?
I mean, the worst thing I could invest in right now is crypto,
Oh yeah.
because it's sitting something over £100,000, $100,000 for each one. And it's like I think it's the aeroplane game. I think it's like you've got crypto, and you're just waiting on other people buying into it to push the price up. It doesn't actually. It's fictitious. It's like if you watch Wall Street, the boy goes.
Yeah.
It's like when he says, "Where's all the money?" and he goes, and like it flies away,
Gone.
like it's nowhere. And effectively, that's
In the
what it is.
ether. For me, crypto, it's just kind of in the ether. Is it really?
Is it in ether though?
Yeah, well,
It's just,
yeah.
I think it's just a made-up thing. It's like the Emperor's New Clothes. So everybody's convincing themselves it's the thing, and they're all investing into it because of it. And when it tanks, it'll tank.
Yeah.
And if it keeps going, good on you.
Well, what?
But I'll tell you
That's
what.
a big risk.
I'll tell you what. Crypto, the amount of crypto companies that have started, only 1% survived. So how much money did everybody else lose?
Must have been a
Look at
lot.
that MMA fighter.
Yeah.
Lost about 30 million in the last crash. And it's like, you don't hear anybody now saying, oh, he got his money back. Because I think the actual company was running the crypto scheme actually tanked.
Yeah.
And you lost the whole lot. So that's what people don't realise. It's like, you look at this in hindsight and go, oh, have I bought crypto? But who's to say you bought the right crypto? Who's to say you invested with the right company? It's just like pensions. Some pension companies are long equitable life. That was wiped out in the credit crunch. It disappeared.
Gone.
Yeah, and people lost their pension. Some of the companies that had pension schemes as well, BHS, you know, that TV
Yeah.
group, that was wiped out as well. I mean, we deliberately engineered that. We now know that. But that's the type of things that have happened. And this is the thing. This is why a lot of companies wanted rid of their pension funds. They didn't want to have that obligation about having to keep that maintained. They just wanted to give them money, defined contribution, and say, there you go.
Yeah.
There's an amount from you, and that's why it's set up like this today. So I think these are all the things you've got to think about. And the true investment return should be assessed in the context of investment discipline, patience, and strategic consistency. Again, I'll say it. Write it down. Boring pays well. Boring pays well all the time. You don't need to fiddle about with it.
Yeah.
You don't need to
Not
go,
for
oh,
all
should I
the
buy this,
things,
should I
yeah.
buy that? It's easy to get a low-cost index fund and actually just invest in that and let it grow over a period of time. The S&P 500 has outperformed the FTSE 100, but then the NASDAQ, which is the technology
Yeah.
stocks,
True, yeah.
whether that's going to be a bubble or not, time will tell. You never know. The bubble might have gone by the time this goes out. But whether that ends up being a bubble or not, I don't know. But the NASDAQ's gone up like in the last 5 years, 1,200%. Or is it 120%? Maybe
It was
120%.
120, yeah, it was.
120%. And the FTSE, the Standard & Poor's has gone up about, I think it's about 90%.
Yeah.
And the FTSE has gone up about 60%. Now you could cry in your spilt milk. Oh, you cried over spilt milk when you do this. Oh, I wish I'd done that. It's like, but do it now.
Yeah.
That's the key. When should I invest? Now. Now's always the time. Because over a long period of time, it compounds. But you've got to get the right investment. You can't invest in high-risk stocks or high-risk strategies. I used to see, but the high-risk strategies were quite important because I remember I used to work at Standard Life years ago in actuarial department, calculating surrender values and stuff like that.
Yeah.
And I remember there were some people, it's like calculating the returns and like, you've actually got less than what you started with. And I have a sneaky suspicion it had something to do with arrangement fees.
Well,
Yeah.
we've looked at that before, and well, I would agree with that.
I do have a sneaky
yeah.
suspicion it had something to do with arrangement fees and the fact that there was
What is arrangement fees?
Yeah.
In the background, yeah.
And then obviously later on happened, I mean, this was the early 90s, so you're talking about 30 years ago almost. So when you look at that and you work it out, that was all, it's all now governed
Yeah.
by the proper authorities to do that. I think it's the FSA, Financial Services.
Yeah.
Oh,
No,
FSC, Financial
Conduct.
Oh, FCA, Financial Conduct Authority. FCA? I don't know.
FCA.
We know what it is anyway, if you get the gist of it. So, let's kind of wrap up here
Yeah.
from NECA, because I'm wanting to get out in the sun
Yeah.
and get more time here.
I think to really conclude it all, I think when you're talking about the true investment return, what we're trying to say is that it's kind of multi-dimensional, but it really accounts for not just your capital appreciation and things when you're thinking about property, but your income. But you've also got, like you said, inflation, we've got other costs, maintenance, we've got taxes, we've got that risk involved. You have to think about the opportunity costs and how your behaviour and what you choose to do and how you invest has got a big part in it as well. And if you don't get these numbers right at the beginning and think about what you're actually going to have to put in and what you're going to get out over that period and what kind of period of time, 10, 20 years, to make compounded significant return, it's never going to work.
Behaviour's a lot to do with it.
Yeah.
This is why I mean about the boring pay as well, and just don't touch it. There was I'll give you an example of this. There was some sort of story, I remember there was an analogy or something like that. how this Japanese car manufacturer had all robots in their place, and it's like, and they says, well, if you've got robots, why you got this guy? Anyway, well, that dog's for security, and the dog provides security for the factory, for the robots, but it also stops that boy from touching the robots, because he's there to feed the dog. Honestly, and that's what, because it's like you just can't resist it. Mm-hmm. If something's there, it's like, oh, I'll just tinker with it, I'll just fiddle about with it, and that's what happens with a lot of people with stocks. And then what they don't realise when they're buying and selling stocks, they're paying arrangement fees every single time.
Yep.
They are not free. It's like currency. They're getting it at 120, they're selling it to you at 110. So you're getting less, but they're making the margin. So they are charging you fees by the back door via how they're doing it. And that's what they do when you buy and sell stocks. Oh, we're no charging you for buying and selling stocks. Well, you are, because you're buying it for £1 and you're selling it to him for 110. Mm-hmm. And that's how they're doing it. So they get a rebate every single time, and it's not classed as charging you fees. So that's,
in essence,
so that's why you don't want to really turn over a lot of. You don't want to. You only really do it yourself. You know what you're doing. In all honesty, I would say only do it. Only dabble in stocks if you know what you're doing. Other than that, just buy an index fund or a fund or a good fund manager, Standard Life, Scottish Widows, Prudential, something like that. It's and understand the risk in that. They will also put you in touch with an advisor if you don't have somebody, and you might know a financial advisor if they want to take you over that as well. I think that's important as well. So focusing solely on nominal returns is akin to judging a car purely by its top speed. Ignoring fuel efficiency, reliability and safety. Think about that. Because then if you judge it all on top speed, we'll all be driving the fastest car. Mm-hmm. But it'll probably be the dearest car because it'll be a Bugatti Veyron or something like that. When you think about it, or a Ferrari, or a Lamborghini, that's kind of what we do. So, and I'll be honest, if I was going to have an accident, I'd rather be in something like a Renault, because they've got a good safety record, than possibly a Ferrari, because then something could go right over the top of you because it's low. So these are all the different things you've got to think about.
You're absolutely right. Yeah.
So by understanding and measuring true investment return, investors can actually make informed decisions and better align with long-term financial goals, preserve wealth as well, and ensure that investment outcomes reflect the reality of the benefit rather than the headline figures. It's so important. Yeah. Let's finish off there. Yeah. Final words for you out of this. What's the one thing you saw that you think that people really should follow on with and understand?
I think for me, and as I see it quite a lot, and as I deal with a lot of buy-to-let investors who are new and coming into the sector and do buy-to-let property investment, we don't take in the full picture of what the cost involved and what they're going to have to put in. Yeah. And a lot of them are really, being keen is really good, but they're keen to make profit in like a couple of years. And it's like, no, you're not going to do that. No true profit anyway. You're going to have to wait, like you say, 10, 20 years ideally.
The classic for me when it comes to that, for my bit of advice, is when people buy property, they go, oh, but as long as it covers the mortgage.
Yeah, that's so bad.
It's like, that is the worst thing I've heard ever. If you ever say that to yourself, don't
think about why you're saying that.
Don't invest in property. Yeah. Just stop right there. Don't. Go and do something else that's safer, because you'll never make a return on property, and it'll cost you an absolute arm and a leg. It'll cost you a lot more money than you expect. I put a hell of a lot in when you think about the amount of money I spend on it, and repairs, improvements, and refurbs and everything. But I put it in to make sure I get a maximum return.
That's what makes, like, obviously I look after your portfolio, but that's what makes it so easy, because I know that. No, that needs done, get it done. There isn't, to a certain extent and within reason.
Well, look at it this way.
You know what it's like? I've got the freedom to reinvest into that stock, and that just makes it so much easier.
Here's the most cost-effective way to maximise your return on a property. Yeah. If you've got a big, huge bedroom with two main windows,
split it in half,
and you could split it in half by subdividing it, and you could create 2 bedrooms out of that. You just engineered another bedroom with something that's going to cost you £1.5 to £2 grand to put up, possibly even less. And that's what you need to do. And when you think about the £2 grand you've spent on that, and you get another £100 in rent every month, you're getting maybe £1,200 a year. Therefore, £1,200 divided by £2 grand, that's over 50% return on your £2 grand that you spent.
I've had a landlord do that recently.
Plus the fact is, even though the square footage or the square metres is the same, you potentially add a bit more value on the property, don't
Yeah,
you?
of course, you'll be able to have 2 bedroom and 3 bedroom.
Because you're a 3 bedroom.
Yep.
And surveyors argue about, oh no, it's the same floor space, but it's
No, no.
like, no, but you're still creating another bedroom, which means you've got more demand for that type of property, because you've got somebody that needs a 3 bedroom now to buy that.
But a bigger family unit
Yeah.
or something.
So you've got people that want a 1 bedroom, people that want a 2 bedroom, people that now want a 3 bedroom. You've got 3 different audiences.
And if you pick up a 2 bedroom house that's got scope to do that in a popular residential area, with schools and everything nearby,
And that allows you
Winner.
to exit quite easily as well.
Yeah.
Because it becomes a more attractive proposition, especially if you're sub 100,000 or just over 100,000. Because it still makes it accessible to first-time buyers. It still makes it accessible to downsizers,
Yeah.
possibly. It still makes it accessible to even upgraders from flats. If you're
Yeah.
getting a mid-terrace house or a terrace house.
Yeah.
Now, to people in some areas like London, and that they were going, sorry, 120 grand for a 3 bedroom
Yeah.
terraced house. It's like 120 grand wouldn't buy with my shed. but honestly,
we're obviously
it's acres of diamonds right in
Yeah.
front of you, and it's finding the areas and understanding the people who understand these areas. They can maximise the returns possible, occupancy rate, running costs, net return, rather than actually gross return.
and paying for the people to do things for you and look after the sort of management, mortgage brokers and things as
Absolutely.
well.
Definitely. And that's it. We'll end there.
Yeah, we will.
Thanks very much for joining us from
We're going to have to get back to the office.
Yeah. See you in the beach.
We'll be back in the studio next week.
It's bye-bye from Larry Page. From is he over there? Well, he's still working on his island. It's not a 5-year project yet. But bye from Nick and Island.
Yeah.
And see you next week.